Well, good morning, everyone. I'm Dr. Chris Ellis. I've been looking forward to this podcast of Doomer Optimism with Graham Summers and Matt Smith for probably a month and a half to 2 months, trying to get these two individuals together, both very astute in their various ways. I'm going to do introductions first, and then we're going to jump right in. We're going to talk about 6 topics today. We're talking about markets, we're talking about metals, we're talking about money, and then we're going to talk about policy, and then preparedness, and then predictions. So first of all, we've got Graham Summers here. Graham is the founder and CEO of Phoenix Capital Research. He earned his master's of business administration at Duke University. For full disclosure, I've been a client of Graham's for about 5 years. He runs a a variety of investment newsletters covering crypto, covering markets, covering individual stocks from small to large. And I've had Graham brief generals and admirals at Indo-PACOM and at Northcom just about his knowledge of macroeconomics and how things go. We also have Matt. I've been following Matt for a couple of years via a friend and then via Twitter as well. Matt's takes have been very interesting to me over the past couple of years because I find him to be a very astute individual. He's an entrepreneur. He runs a regenerative cattle ranch in Uruguay, and he also is a co-host with Doug Casey's Take on that podcast, and then also runs an investment newsletter called Crisis Investing. So exceptionally glad to see the both of them here. I'm Dr. Chris Ellis. I got my PhD at Cornell University, specializing in international relations, but really my focus niche is preparedness and macroeconomics. And for full disclosure, while I am associated with the Department of Defense, nothing here in this podcast from what I say should be treated as an endorsement by the Department of Defense, the Department of the Army, or my current command. But with that, we're going to jump right in to markets with Graham. Graham, what I want you to do is kind of set the baseline here. There's a lot going on in the world, but there's investments in stocks, there's investments in bonds, and then there's the currency market. Can you please try to explain the three of these markets, kind of their size writ large for the viewers?
Sure. So the financial media and the broader culture typically likes to focus a lot on stocks because, well, for one thing, the bulk of Americans' retirements are in stocks through retirement 401ks and the like. And moreover, stocks tend to have a higher level of volatility. In currency markets, it's unusual to see a 1% move or a 2% move in a day. Stocks, you see companies moving 50, 100% in a day at times. It's a very volatile market. And that volatility on the upside translates to profits, which is what everybody. So stocks tend to be, I guess, the sexier asset class. But from a systemic perspective, they're actually one of the smallest asset classes we have. The stock market as a whole, I believe, is about 80 trillion in size. By way of comparison, the bond markets or the debt markets are over 300 trillion in size. And then the currency markets dwarf even that. We don't know exactly how large the currency markets are because, unlike stocks or bonds, currencies are always traded in pairs. So you can't just add number of dollars, number of euros, et cetera. What we do know is that the trading volume for the currency markets is about 7 trillion per day, which is between 20 and 50 times the average trading volume for stocks. So we know this is a market that absolutely dwarfs the stock market in terms of its systemic relevance. And because of all this, when you get situations where things start to sort of unravel, the big focus for policymakers, specifically central banks, is actually more currency and bond markets. Stock markets get things on the front page of the newspapers, they get people's attention. But if stocks kind of go into a bear market, Americans and investors in general become poorer, which has a wealth effect. But if bonds start to collapse, then you have entire countries entering systemic episodes like what we saw in the early 2010s with Europe, what we've seen at various points throughout history. So really, in terms of how we need to think about things, from a personal perspective, you're going to be more focused, obviously, on stocks because it's highly likely you have exposure to them. 60% of households do in the United States, which makes it only the second most owned asset class after real estate. But obviously, real estate typically is, the largest transaction of your life. That's something that you're typically living in. It's not something you're considering as a speculative instrument or something that you're necessarily, trying to retire on. Stocks, you are. But stocks really are a more minor asset class, at least in terms of the people who wield tremendous power as far as our economy and financial system are concerned.
Okay, thanks. And we have a bit of an echo, so I'll just have to play with the mute here. So, Matt, you're actually living in Uruguay right now. What are you seeing as far as not just for that country itself, but for South America writ large, as far as these currency markets and investments, et cetera?
Well, to be honest, I don't invest in the South American stock market at all. There's sometimes where it is. I think there have been some speculative opportunities to invest in, like there's Argentine ETFs. I guess that's not true. I do own some Ecopetrol, which is a Colombian oil company, and I guess I have owned Petrobras from time to time. But that's more of just a bet on natural resources, to be honest. So the markets in South America are super tiny, much more volatile than the U.S. market is, much riskier generally, and much less well invested in. And I mean, I can't even imagine the number of the percentage of Uruguayans that actually own stocks. If in U.S. if it's 60%, if it's 5% here, I would be surprised actually. So it's just not something. It's an American phenomenon, really, where there's such active public participation in the public markets.
Fascinating. That's something I did not know. Are you seeing anything kind of writ large or with discussions with Javier Milei? Do you kind of right next door there in Argentina or not?
Well, I mean, there's a lot going on over there, and I think a lot of the things he's trying to do are really fantastic, and I totally support it. But it's not easy. It's like what the Trump administration is attempting to do in the U.S. I mean, they're trying to turn a ship around, and the ship is it's a giant cargo container, times 1,000, and it's very, very difficult to turn. A lot of institutional inertia is against it. And even though I think the Argentine people, for the most part, still support Milei, the truth is that the cost of living there has gone up a lot since he's been president. Argentina was considered by at least expats a very cheap place to live up until, well, I'd say about a year ago, which is about as long as Milei has been in. And since then, the cost of living has gone up dramatically. So asset prices haven't followed yet. I think they will. Asset prices will start to go up. One thing that is good, though, is I did learn just 2 weeks ago, actually, that the average Argentine salary, which had it's very low in dollar terms, it had been about 18 months ago, it had been about $400. Just $400 a month was the average. Now, very difficult to live, and with huge cost of living rises, you wonder how they could make it because literally food costs tripled. But actually, the average Argentine wage is over 1,000. So actually, wages are starting to push up to try and make up for it. So actually, the typical Argentine is doing better today than they were when he came in, even though the cost of living has gone up so much. So it's such a complex situation. I mean, I think he just should have killed the central bank when he came in, as he planned to do. I think he should have defaulted on the debt. It's unpayable. They have no money. But those are hard decisions.
Okay, I know the IMF they were looking at another loan here recently, and last October I was in California for the World Championships of obstacle course racing. I met an Argentine couple, and I was talking with the husband quite a bit, and he's a little bit pro Malay, and he goes, "I'm glad my wife doesn't speak English because so she can't hear this," and talking about the ways he was positive for Malay. But moving back to Graham, so Graham, kind of writ large in the markets, you do this very professionally for both macroeconomics and also for American investing. What are you seeing writ large in the markets?
Wow, that's a question. Had you asked me that 2 months ago, would have been a very different discussion than the one we're having right now. Um, a lot of what Matt was saying, excuse me, is sort of what's trying. The Trump administration believes they have this mandate to try to undo 3 to 4 decades worth of macro policy, and they're trying to do it in a kind of blitzkrieg fashion. And I don't. I think that's in many ways very admirable. I have to be very careful with how I describe these things because the reality is, as we're finding, there's these views that you can kind of change things, but the reality is change always involves cost. And for instance, with the trade war that they launched, the initial idea they had obviously was, well, we are going to focus on Main Street. We don't care about Wall Street. If stocks collapse, whoop-de-doo. We're going to just focus on reshoring, undoing outsourcing, trying to bring back the manufacturing and industrial base, because from a strategic defense perspective, that makes more sense to make our economy more robust and self-sustaining. Then stocks erase $11 trillion in wealth in 2 weeks, and the bond market starts to revolt, and they quickly pivot, and they implement a 90-day reprieve. They lower the tariff rates that they're imposing globally. And so in many ways, the market's kind of called their bluff. This idea that, as Matt put it, these are gigantic cargo ships. These are like oil tankers when you're talking about these economies. They don't turn quickly. And you can do shock and awe policy and you can do that sort of thing. But the reality is these are politicians and they're playing a political game. And a political game also has economic implications. And in the case of the tariff trade war, when stocks erased all that wealth, you suddenly started seeing all these companies issuing warnings. PepsiCo, Chipotle, Walmart, McDonald's, even Southwest Airlines all said that consumers were suddenly pulling back on spending. And the reason for that is the wealth effect. If the bulk of your net worth is tied up in stocks or in housing, and both of those, especially stocks, get shellacked, then you suddenly feel poorer and you're less likely to spend money, even though technically the money that you spend is coming from incomes. That wealth effect is real. If stocks go up through the roof for 3 years, people spend more money, even though their incomes haven't risen in a commensurate fashion, because they feel that they've got a lot more in the bank and their future's more secure. So what happened was when they did this kind of nuclear option with the tariffs, where they just said, you know what, we're going to do this, 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 and this. We're going to apply it against the entire world. We're going to, do reciprocal tariffs against everybody. We're going to do tariffs against bad actors that are higher than against others. The entire system kind of revolted against that. And now they've pivoted and approached it in a much more kind of like market-centric approach, I guess you could say. And I'm not saying one way's better or the other. I'm just simply saying they quickly found out that this stuff doesn't work in a vacuum. And, if you don't want to risk a recession, you can't necessarily just do this in such a kind of aggressive fashion unless you're really willing to stomach it. And, I think in Argentina, people probably got to the point where they were so fed up, they were willing to maybe stomach some of that stuff. In the United States, I don't know. It's certainly the other thing that was confusing and very peculiar was that, the institutional inertia, as Matt put it, really sort of is biting the Trump administration. And it's very strange. You'd think that large institutions that derive their profits from capitalism and from the U.S. markets would be pro the United States strengthening its economy. But what you're actually finding is, across the board, it seems as though the coverage, whether it's from Wall Street or the financial media or even the Federal Reserve, our central bank, has been extraordinarily negative about what Trump's trying to accomplish with the trade wars. And it's kind of funny because it was almost as if they were cheering on a kind of Trumpageddon, we hope this thing just blows up in this guy's face and it's a disaster, which is really peculiar if you think about it. You're actively rooting against an American-centric, pro-domestic policy from a macro perspective. And what was the most extraordinary was that the central bank, which is called the Federal Reserve, or the Fed for short, they actively were criticizing and even thwarting these policies. But that in of itself is extraordinary. I mean, in 20 years, I've never seen central bankers in any country for that matter come out and say, we're against what this guy's doing. Tariffs, they didn't say it in those terms. They always couched it in central banker language, but it's essentially tariffs are going to make inflation go through the roof. Tariffs are going to hurt the economy. Our jobs are going to be a lot harder, yada, yada. That's one thing, especially if you're doing that when everything's stable. But when you've got stocks, bonds, and the dollar all plunging because capital's fleeing U.S. denominated assets, and your central bank is doing this, I mean, that's extraordinary. The primary role of a central bank is financial stability. Your job is to actually assuage concerns and try to sort of ameliorate, things that are unraveling badly. And instead, we actually had our Fed chair come out and give a public speech and then a Q&A session where he was pretty much abjectly criticizing what the president was doing, saying that it was effectively a massive mistake. And stocks and everything reversed that day when that happened. And I don't know exactly. I mean, obviously, there's a lot of politics in the Beltway, and the Fed's based in D.C. It's very obvious that the Fed hates Trump with a passion. But that, to me, was particularly extraordinary because you not only have a situation where you're trying to undo decades of cultural and institutional inertia in the economy, but you've also got the sort of pillars of the financial system whose role it is to create financial stability actively trying to thwart what you're trying to do at a time when everything's melting down. So I think that made things a lot hairier for the Trump administration. And I really wish them luck with what they're trying to accomplish. I certainly wouldn't want to be trying to do it. I can't imagine, you know?
So I'm going to pause you on that part. We're going to pull several strings from that, but I'm going to go to Matt. So Matt, gold's been one of the best performing things to own for the last 60 years, and gold hit $3,500 just recently. Can you kind of tell us a bit about how the metals market is reacting to a lot of this uncertainty?
Well, the gold in particular, I've never looked at it as an investment. I've always considered it savings. If you wanted to preserve the value of your dollar, then it was savings. So if you're just holding on to a lot of cash, then it made sense to have it as savings. The way it's performed, though, especially in the last 12, 14 months or so, though, makes it look like something totally different. It makes it look like it's an investment vehicle of some kind, but that's not really, I don't think, in my opinion, I don't think that's what's happening. I think that whether Trump is inducing it himself or it's being forced on him by third parties like China, the fact is that I think that we're in the middle of a monetary reset of some kind, where we're going to walk out of this with a totally different monetary order. The Bretton Woods order, which is we've been sort of pretending to live off. Basically, everybody got rid of their own gold-backed currency and pegged to the U.S. dollar. And then the U.S. got off the gold completely in 1971, and it's all been free-floating fiat. It's all like what we call money is a floating abstraction. I mean, it's not based on anything, but that's traditionally not the case. Traditionally, money was gold. Okay, so lately, gold has looked like a remarkable investment, and I think that's because not because a lot of retail investors are interested in it and driving the price up. It's because central banks have been buying it hand over fist, and it's not just that. You see this certainly. China reports that they've been buying a lot of it. Goldman Sachs came out with a report, I think 6 weeks ago, that said they think that they underestimate what China has, or they're understating what China has by 10 times. I mean, that they actually have a lot more gold than they claim to have. And it seems to me even the U.S. has been buying it since Trump came into office. I mean, there's 2,000 tons that have come into the U.S. Now, that's like roughly a quarter of the giant hoard that supposedly the U.S. has come in this year. That's an insane amount. I mean, it's actually altered our GDP, the importation of gold. I mean, it's really wild. So I think that the central banks are preparing for this monetary reset right now, and so what we're seeing in the huge price appreciation is we're seeing. There's this thing. I wish I had a graphic of this. It's Exter's pyramid, and it basically shows gold at the bottom of the pyramid, and it goes up, and you get into these. You have the bond market, the stock market. You have real estate in there, and then you get into currencies, and then you have derivatives on top of it. So these are more abstract measures of wealth, really, and all at the bottom of that is gold. And in this currency reset, this monetary reset, I think that we're going through right now. Essentially, that's being reconciled. So somehow that little tiny bottom base of gold has to be reconciled with all of this credit that is out there in the system. And as things get turned over, and actually it's going to be a wild time. I think everything is going to change in ways that it's very difficult for all of us to imagine when we just reconcile with the fact that this since 1971 not just the U.S., but the entire world has been operating on a totally fiat system, totally made up, all based upon the issuance of massive amounts of credit. And this is part of what Graham referred to, the pro-American policies that Trump has. The way the trading system is set up, in many ways, it's benefited Americans, meaning our primary export is dollars. We print dollars. We send dollars to the world. Those dollars come back into the bond market and into the stock market, so inflating our asset prices, and we get lots of goods. And it's been a great deal. The problem is, as is pointed out by several people in the Trump administration, it's a totally unsustainable thing because it actually requires the U.S. to continue to produce dollars for the world, to keep sending them out. And for that to happen, you have to have manufacturing overseas, so the things that we can buy, and it keeps the dollar artificially high. That's a problem when it comes to global trade balances. So that's why when you see Trump making these crude and dumb comments, when he says things like Canada's ripping us off, what he means is that we have a trade imbalance with them. So, we're sending more money to Canada than Canada is sending to us, but they're sending us goods. But in his mind, he says rips us off. And I think that might just work for it might just be a rhetorical device that's helpful to help people understand the problem. But fundamentally, you can't have a totally out of balance trade system forever. And in a world where gold were money, it would be impossible, because eventually you have no more gold because you've bought all the goods from other places. Now they have all the gold. Now you can no longer buy things. Now you have to produce things to get gold back to you. You know what I mean? So gold keeps a natural balance in there, and I think gold is going to re-enter our trading system in some way, and we already see it with what China has been doing, in their own trade.
So we'll come back to that here in a minute. I kind of want to stick on the metals, though. What you kind of just explained is basically the Triffin's dilemma, and we'll hit that a bit on policy as far as the trade imbalances. But the gold-silver ratio right now is over 100. So if the argument is that gold is being used right now for a flight to safety or a long-term investment or a currency pair to maintain the value of what you have as far as your assets, why hasn't silver caught a bid yet and caught up with gold? Why do you think that is?
Silver isn't primarily a monetary metal. It's an industrial metal. It's actually way too useful right now to be a monetary metal. I mean, so the great thing about gold is it's a beautiful thing. You can use it. Has some utility in jewelry, but it's not useful in the economy. So we don't mind putting it in a closet or burying it in a vault. There's nothing better we could be doing with it other than just holding its value. But silver, on the other hand, is a metal that is used in all the high technology that we take advantage of today. So it's an industrial metal first and foremost, and is definitely trading that way. And I think the gold and silver ratio, that's these. I think people make too much of these things, because you can look at it. It was different when silver was not as useful as it is today. So looking at them when they were both monetary metals and considering that ratio to today, when what we're trying to do is we need to reconcile these however many quadrillions of dollars of derivatives that are out there in the Exeter's pyramid with the money system, that ratio could get much larger. Actually, I think maybe it'll end up coming back, being closer together at some point again. But I could see it getting to 170 or 180. It could really get extended from here. So, because right now there's demand for gold from central banks. Just imagine once retail wakes up and starts deciding that they need to own some gold, then that's going to only extend it further. Although when that finally happens, people will start buying silver too. Retail will be interested as well. But yeah, I wouldn't look at that number and think that that's something sacred. That has to go back to 16-1 or 18-1 or whatever that magic number is. Although I heard from a miner that they're actually pull it out of the ground at a 7-1 ratio. That's what he said from his company for last year. So,
All right, Graham, I know you want to jump in on this. Go ahead.
I was just simply going to say he's exactly right on a lot of those things. And, just in terms of why is gold acting one way and silver another, you have to also consider the price per ounce. If you're trying to put a ton of capital into something that it can sit in that's not going to be depreciated by a global monetary reset or by a decline in purchasing power from inflating away these debts, an ounce of gold's $3,500, give or take. Silver, it's much lower. That's like 30, something like that. So my point is, if you're trying, you got $1 million you're trying to store somewhere. Gold, you can do it in a relatively small pile. Silver, you'd have to have briefcases of the stuff. Very well put, Matt. Very well done. That was great analysis.
So Graham, let's before I leave metals here, there's one more metal I want to talk about a little bit, because Copper said it's the metal with the PhD in economics.
Right.
So if you're looking at various companies and countries, as far as their health, one of the ways to do that is to look at their copper production, or not copper production, but copper utilization. So, what are you seeing kind of internationally, or even just nationally here in America, as far as copper utilization? What is that? What insights does that give to you? To give to us?
I haven't actually been focusing so much on that lately because it's been kind of screwed up by China. The fact that China has hoarded so much copper and for inventory, and China has this crazy shadow banking system where collateral is many times a hard asset. Not in our country and in a lot of the Western world, when you do these large trade deals or you do a large kind of contract, you use collateral to back it, and the collateral is usually a paper asset. It's usually a debt instrument of some kind. The senior most debt instrument being treasuries. Treasuries are the senior most asset in the entire global financial system. They're considered to be the risk-free asset against which everything else is priced because, as Matt put it, we're in this fiat world now. There's no hard assets backing anything. And so the best you can do is debt that can be paid back by Uncle Sam, which is the largest, most dynamic economy, which has the reserve currency of the world, which can be printed at will by the central bank. So technically it's, quote, risk-free because no matter what, you'll get your money back. The actual value of what that money is going to be is a different story. But copper, I haven't really been looking at too much because it's been so badly skewed. It's very much an economics, a sort of growth story to see what copper's doing. But in terms of actual copper plays and what I'm seeing in terms of what that's predicting, that kind of got punched in the face like everything else with the trade wars. It's very hard to, we've had this weird window of time where what was something actually worth and no one knew, because 28% of revenues from the S&P 500 come from international markets. A huge amount of profits do. And most companies, actually very few companies, produce anything start to finish anymore. You talk about a company like Apple, you talk about BMW, you talk about Target, you're talking about 500 to 1,000 suppliers for their finished products. And those suppliers are all in different countries with different, and many times different continents, that we're all suddenly going to be hit with tariffs. And as a result of that, no one had any ability to sort of predict what is the value of this stuff. You had these crazy days where Costco would go up because investors were thinking, well, Kirkland primarily sources from domestic suppliers, but then Amazon, which, gets so many of their goods from China, just imploded. But, comparing those two companies it's ludicrous. They're not even remotely comparable in terms of their business model and how they function. So we've had this kind of weird, like a bomb went off and everyone's just shell shocked for the last few weeks. And what changed was, and I said this to clients, I said, this is either this is the market's going to just stop caring about the tariffs because it's going to realize the Trump administration is just sort of shooting from the hip. Because that was the other thing. It's not as though these policies were rolled out in this polished, elegant fashion. It was every other day Trump's on Truth Social saying, well, we're going to do this against China. It's like, oh, well, then, this country is screwing with us. We're going to do this to, and it's very hard to make any predictions based on that. So we were all waiting for one of two things. One was the market either was just said, you know what, I don't care. Whatever happens can't be much worse than what's already happened. And since stocks discount the future, gradually things get better, so it starts going up, or central banks panic and start easing, and you get a tsunami of liquidity. I actually think we're going to see that coming. I think Matt's correct. We're likely to see another monetary system created, but I also think gold is anticipating that there's really no way out of the current economic predicament that doesn't involve massive money printing. Japan's on the verge of a recession. Europe's on the verge of a recession. China's entering deflation outright. And in some ways, they've got a death spiral in certain segments of the economy. The United States, we've quickly found out that as good as the economy looked, as soon as the stock market really implodes, people pull back on spending and the consumer's 70% of GDP. So the reality was when COVID happened, we embarked on this bizarre experiment to the tunes of millions of jobs and trillions of dollars that you can just paper over the real economy shutting down. And we're still dealing with the after effects of that. And I think the end result is we're just too far gone. We're at the point of absolute no return where there's no way forward that doesn't involve more money printing. And I believe that's why you're seeing gold not only break out against the dollar, but it's breaking out against the yen. It's breaking out against the euro. It's breaking out against even the Swiss franc. Switzerland's typically considered a fiscally careful country. Gold's erupted against the franc. And I think gold's just essentially telling us that globally, capital has figured out that there's no way forward that doesn't involve more stimulus at some point. And that includes the US, despite the claims that the Trump administration wants a balanced budget. There's just no way forward that doesn't involve more money printing, more stimulus. And maybe COVID was this weird mulligan where everyone sort of was willing to go past it because they were worried about dying at the time, or because, asset prices were going up so rapidly, everybody was feeling richer and willing to stomach it. But another round of serious global stimulus at this point, when these countries haven't even normalized. You look at the deficit the United States is currently running. We're running a deficit equal to 6% of GDP. That's like what we ran after the great financial crisis, and our economy is technically still growing. So we all know that's only going to get worse if things roll over from the economy perspective. So I think gold in many ways is, Matt's dead on. There's a currency monetary restructuring which has to happen simply by virtue of the fact that there's no way this debt's getting paid off by anybody. And secondarily, I think that gold's also figured out that it's one of the few options where you can store a large amount of capital. And yeah, it's volatile, but you don't necessarily have it collapse 30% in a day like some stocks have been doing. And who knows what bonds are going to be worth, because you start stimulating again, central banks are going to have to use money and buy debt markets, buy bonds like they did with QE the last 20 years. So I think gold's just kind of, people realize this is this sliver of the financial system where I can maintain purchasing power. I have it in my possession, and there's no, paper-based collateral where my counterparty risk means it might disappear overnight.
So we've kind of transitioned into the third topic, which is money, and I don't want to get into a philosophical conversation of what is money and what is not, and go back to bimetallism, et cetera. But 2 points. One, if money, my American dollars, is being inflated because of policy decisions, because of tariffs, et cetera, but so is the Swiss franc, and so is the Japanese renminbi or yen, and the Japanese yen, et cetera, and all these other countries. If everyone is doing it, then why do I care if my house price goes up by $100,000, but my dollar deflates by X amount? But in the end, it's all kind of a wash. Then why should we care? Are you seeing so that's part one, is just if everyone's doing it, then why should we care? And then B, if we're looking at this, are we looking at inflation right now, or are we looking at deflation? Because tariffs are very deflationary right now, but you guys are both talking about a monetary reset, which involves money printing, which is inflationary. So is it all of the above? Is it stagflation? I mean, where are we at? I'll start with Graham and then go to Matt.
Wow. Depends on the country you're talking about. I agree with you. Tariffs are primarily deflationary. This idea that tariffs are inflationary and they're somehow going to blow up the system. Well, if that was true, then all the countries that have implemented tariffs in the last 50 years would have blown up. They didn't. They were fine. That's another weird thing the financial media jumped on when Trump introduced this. Oh, Trump's going to destroy the economy. It's like, well, it hasn't destroyed China, hasn't destroyed Europe, and they're far worse than we are in terms of that thing. But in terms of deflation to inflation, I mean, historically, what you typically see is that central banks try to avoid, Milton Friedman once said the Fed's a bit like a guy getting in a shower. He turns it on to hot. By the time it gets so hot, he's immediately trying to turn it back to cold because it's too, and then it gets too cold. He's always behind the curve. He's always sort of like not proactive. That's essentially what we've seen. The central bank is currently fiddling, claiming it's worried about potential inflation, which is bizarre because they themselves created the worst round of inflation in 50 years and then lied about it for over a year, claiming it was transitory. So it's kind of weird also to see, our central bank was easing within 60 days of a presidential election at a time when financial conditions were, looser, the economy was growing more rapidly, inflation was was higher. And now they're saying, well, we're not going to ease even though the economy's weaker and inflation's lower and financial conditions are tighter. But, that's sort of just a jibe at the Fed. But essentially, what they typically do is deflation hits, they panic, and they print a ton of money, and then inflation arrives. The reason it didn't really happen previously, a lot of people thought it would after the great financial crisis, was simply by virtue of the fact that the money wasn't actually getting into the economy. It was just sitting on bank balance sheets. When the Fed printed money and bought assets, it was mostly going to institutions. With COVID, they actually were engaged in abject stimulus where the money went straight into the economy, which combined with supply chain disruptions was why we had inflation. So in where we are right now is we've just had kind of a deflationary mini bust, so to speak, in the financial markets. There's deflation appearing in China, where a lot of factories are now just dumping goods on the domestic markets at any price. It's one thing if prices come down because there's advances in technology or productivity. It's another if you're just selling at whatever price you can get it for. That destroys profit margins. You're out of business very quickly. So there's deflation in China. It's going to be interesting to see how they respond to that. It's going to be interesting to see what time the Fed actually really sort of figures out that it's wrong and stops playing politics. That's the best I can say for now. All I can say is that the signs I see in terms of what the market's sniffing is the market is sniffing another round of, or smelling another round of stimulus and money printing is coming down the pike in the next 6 to 12 months.
Okay, so you're thinking that in the next 6 to 12 months, money printer go burr. All right, it's kind of the bottom line.
At some point, for sure. I mean, European central banks already easing aggressively and saying they're ready to act. Bank of England's easing. Most central banks are cutting rates. The Fed's the only one on pause. And you can't tell me these guys are all going to get religion and say, no, we're going to let chips fall where they may when a recession hits.
Matt, what are your thoughts?
Two things. The first thing is, the inflation deflation conversation is a complicated one because you're really talking about, it's easy to conflate two separate issues. I mean, technically, inflation is increasing the money supply and deflation is contraction of the money supply. It's not prices. It's not the price of things. Now that does affect prices. When you inflate the money supply, that can affect prices. But as Graham noted, why we didn't see it at the financial crisis is because why we didn't see it, even though there was inflation in the money supply, it did not affect prices in the same way that most people would expect because it wasn't injected into the economy directly. So it's important to understand that distinction because when you're talking about a deflationary scenario, fundamentally it would be something where credit gets destroyed. So money essentially evaporates. Most of what people think of as money today is actually credit. So when that credit basically evaporates because people can't pay their debts, so it gets written off, that's huge money destruction. And then that causes deflation in the monetary base. So that first. And second of all, your point about the relative value of currencies, I think it's dangerous to think in those terms. I mean, sure, it does affect you. If I'm going to go to Europe this summer and the dollar is strong compared to the euro, that's great. So I have some advantage there. If it's really weak, then then I'm going to pay more for my European vacation. But that is kind of like it's almost like a sleight of hand. Like, don't worry about what your purchasing power actually is. Just look at strong dollar relative to the yen. Look at that. And I think that's really misleading. I mean, I recently posted an article on crisis investing last week because I just finished reading this book. A couple of friends recommended it to me. It's called Path Between the Seas, and it's about the building of the Panama Canal. So starting, in the 1870s when the French started to try and do it. From the very beginning, them working on it, ultimately when the Americans took it over and completed it. And it was a great book. I highly recommend it. If you like history, it's a good book to read. But I couldn't help but every time that this excellent author is going through and talking about amounts, dollar amounts there, I kept making notes in the margin because he talked about, the cost of machines, the cost of hiring a junior engineer, for instance, with 2 to 3 years of experience. Let's say maybe like the equivalent of a civil engineer today and what their salary was. Now, this was in 1910, this junior, when they brought up this junior engineer. In 1910, this junior engineer was earning a salary working on the Panama Canal of $3,000 a year. Now, it doesn't sound like a lot, but that's 150 ounces of gold, okay? 150 ounces of gold, because gold was money then. It was the same. There was no difference between it. But using the dollar, using even the term dollar to talk about the same thing over any historic time period is like it's a floating abstraction. It doesn't make it, they don't actually compute. They're fundamentally different things. This guy got paid 150 ounces of gold. And today, a junior civil engineer, right out of so 2 to 3 years of experience, the average salary, civil engineer, $80,000, okay? Or 18.7 ounces of gold. 18.7 ounces of gold versus 150 ounces of gold. So in other words, 450, that guy, the junior engineer was earning the equivalent of a $450,000 salary. And by the way, there were no income taxes then. Okay. 450,000. Now that guy today would be in the 1% of earners in America. This is what happens when you compare things relatively to other things that are to non-constants. I mean, gold is money. Gold is a good way to measure value, and it stays consistent over time. And I think that if we focus too much on what things cost based upon a floating abstraction, the dollar, it actually messes up our ability to understand. I mean, the base layer of a free market economy is the money system. That's the base layer, right? Because price signals are everything. And our price signals and everything are so screwed up at this point. Nobody knows what anything is worth. I mean, you use the example, Graham, where you're just saying these retailers trying to understand, can we even have these products anymore? I mean, does this make any sense? I mean, if you're about to build a new plant, you have to throw all your work you've done out the window. You don't even know what the prices of anything will be anymore. So it's like we live in an economy today that is like that, but it's stretched out over more time, so it feels somewhat predictable. But in truth, the floating abstraction that is the dollar makes it impossible for people to really plan well. And my main point is that definitely don't, just because the yen is going down also, and the Swiss franc is going down also, and the Uruguayan peso is going down also, don't consider that okay. I mean, it's better to base your money on gold, on the equivalent number of ounces of gold you can get for the dollar.
Okay, fair points there. And it's funny, this hits close to home. My son just graduated. He's a mechanical engineer now, just got his Bachelor of Science degree. And he just got his internship in an engineering company for the summer. So it's hitting close to home for him as far as what his real worth is for being paid, A, and then B, both of my children are in their young 20s. My daughter's finishing up her second degree right now. And the joke they had, there's a meme they shared, and it's basically, what's your biggest life mistake? And the answer was back in the third grade, not taking my lunch money to go buy a house. So we're kind of working through those things as far as how they impact us at this day and age. But that book you were just sharing with about the 1910 getting paid 150,000 or 150 ounces of gold for your salary is pretty amazing. So since we're talking a little bit about history, Matt, I don't want to go through the entirety of history since the Romans first mined it and started clipping off the edges of the denarii, but kind of take us through the modern version of how currency kind of got debased writ large. You talked a bit about Plaza Accords recently, or maybe it was your partner in crisis investing. But why are these historical things, basically since the end of World War I, now impacting us so much, and why can we not escape them?
Well, the big thing is the changes for the U.S. happened first in any real way. You could say when the Fed came in 1913, and you could talk about, of course, the income tax came in at that same period. But it was in 1933 when FDR signed an executive order making it illegal for Americans to own gold, and you were supposed to surrender it at the fair price, which is because gold was pegged to the dollar of $20.67. Once that was done, he devalued gold, or he devalued the dollar, making it so that it was $35 an ounce. And then it's been adjusted several times. I think 4 other times after that, actually. They made incremental improvements later. But ultimately, in 1971, they closed the gold window because, through the Vietnam War, the U.S. is printing more money than we had to really back the gold that we had. So now, while Americans couldn't go turn in our dollars for gold anymore, foreigners still could. So, and trade, gold was still the rule, really. I mean, because we were using dollars because it was more convenient, but at any point a foreigner could say, hey, these dollars are fine, but I'd rather have gold. And so Charles de Gaulle realized, or somebody on his team realized, that we were overprinting, and that the dollars were, they had a lot of dollars, and it made a lot of sense for them to go and convert them to gold. So they were sending battleships over to load them up with the U.S. Treasury gold by redeeming dollars, realizing, and that had been going on for a while, But realizing that that was going to inevitably come to an end, Nixon closed the gold window in the Nixon shock in 1971. And this kind of gets to now. So at that point, it severed the relationship totally, as I said, to real value, which was gold. But at the same time, what Nixon did, because that at the same time, Nixon actually did a 10% across the board tariff. And this doesn't get much attention on, not nearly as much as closing the gold window does, on all countries. And the reason he did that is because he wanted to bring all of our trading partners to the table to sort of renegotiate, well, essentially to get their support in devaluing the dollar. Okay, so so that the trade system would continue to function, because essentially the dollar needed to go down in value for our debts and for it to make sure that our products were still competitive around the world. They did another version of this in 1985. It's called the Plaza Accord. And same thing, they didn't actually institute tariffs writ large, just like directly, as an executive order. But what they did instead is there was a lot of talk then, like people talk bad about China now, China dumping all of its stuff here. China's making all the cheap stuff. China's taking advantage of us. That same talk was about Japan at the time, actually. And so what they did is the Congress was suggesting they were going to roll out massive tariffs against targeting Japan. And so they were kind of played the bad cop, and Reagan was the good cop. And they got all the partners together, and they basically came to an agreement where, again, they would allow their currencies to appreciate compared to the dollar. So the dollar would go down. And it's the stated objective of the Trump administration to devalue the dollar. They made that very clear. So they want it to go down, and they want it to go down relative to our debts to make them payable, and they want to make it go down relative to our trading partners to make it so that our exports are more appealing. So that's the stated objective, and so far they've been despite all the chaos and the disorder caused by what they've done, they've been accomplishing these things. I mean, the dollar, the DXY is a common measure, comparing it to a basket of other currencies, and the dollar has gone down, and that's what they want to do. And what Americans need to know, though, is that that's the goal. So the dollars that you have in your savings, the goal is for those to be worthless. So what are you going to do about it?
Okay, so that what you brought up is called monetizing the debt. I won't even say what regional bank, but I was talking to one of the 400 PhD economists that was employed by the Federal Reserve, and I'll say years ago, just to kind of make it a broad announcement. But he said the purpose of the Federal Reserve is to monetize a good portion of the debt. So with that, I kind of want to switch over to Graham. Graham, you've talked quite a bit extensively about the amount of money that the Federal Reserve has injected into the system over the last few years. Can you kind of give just an overview of the size and the scope of injects of liquidity and over the long term solvency that the Federal Reserve has pushed in, especially because of COVID?
Sure. So the Fed's essentially followed the same playbook Japan's been implementing since the late 90s, which is it's a slow motion nationalization of the financial system. You just gradually start acquiring assets. People forget, prior to the great financial crisis, the Fed's balance sheet was 800 billion, and that was considered adequate and quite large. The Fed now at its peak, it was 9 trillion. And they're now the largest owner of treasuries, the largest owner of mortgage-backed securities. Anything the Fed's gotten involved in, it's now the single largest owner of that asset class. In terms of the money printing, the great financial crisis was a pretty hairy situation, in terms of disruptions to the financial system. The Fed printed I believe it was about $3.5 trillion in 8 years subsequent to that crisis. They printed $3 trillion in 5 months, 6 months in 2020. They printed, I think, peak from altogether, the Fed spent, I believe it's somewhere to the tune of $5 trillion related to COVID. And if you actually take all the currency that was ever printed in history, I think they printed, Matt might know this better than I think it might be 40% of all the dollars ever printed were printed in 2020. So just egregious amounts of money printing, like ungodly. And what it really was just a kind of version of what we've done since 71, just sped up. Essentially the idea was we're just going to, to take some of the things Matt was talking about, this idea of the civil engineer and gold is money, and that fact stares all of us in the face. You go back to the 50s, one parent typically worked, and a lot of middle class families were just fine. They owned their home. Asset prices were not so high that you couldn't afford to live on one income. Now that's almost impossible. You have to be extraordinarily frugal and have a pretty robust income to survive for a family of, say, 4 on one income. And that fact has just been because we've gutted our economy, and then we used funny money, credit, and debt to paper over the decline in living standards. And all COVID did was just that to the nth degree as fast as possible. It's like, you don't even need a job. We'll just send you money in the mail, and you don't have to produce anything. And that was a point of no return as far as I'm concerned for the financial system. They took it to the absolute max. And I don't see that. I think that's why we're seeing so many disruptions now in the financial system, because it's different asset classes are rapidly figuring out that the only way forward is going to be more money printing and more devaluation. And central banks, they can't create jobs or incomes. They don't know how. They're pretty open about it, actually. If money printing led to wealth, then South America would have been the next Japan. And so macroeconomics is actually far more complicated, but central bankers, which is another thing, culturally, central bankers have become these kinds of gods of the universe. You go back to like the 70s, 60s, central bankers were sort of known, but only in some circles. Nobody walked around yapping about the Fed all the time. Nowadays, these guys come out and talk on TV, and the stock market reacts, and they feel like they're like lords of the universe. Forward guidance, just talking, verbal intervention has become a major monetary pull for the central banks. But, the reality is these asset prices are all in some ways based on what Matt was talking about, currencies losing purchasing power. If you compare gold to the stock market, the S&P 500 starting in 1967, which was when France, the first country, severed its ties to the gold standard, gold outperformed stocks the entire time. There's only been very rare periods of time where stocks have outperformed gold. That was the tech bubble and the COVID bubble very briefly. And the reality is most stocks don't outperform gold in terms of long-term returns. Some do a lot. You compare something like Apple the last 15 years to gold, it's not even close. But the S&P 500 against gold, it's a totally different story. And so gold is kind of an interesting way of telling you, is a company actually legitimately producing something of like great value that's growing rapidly and increasing productivity, as opposed to, is this stock just going up because it's denominated in dollars and the dollar loses purchasing power all the time?
Okay. So we're going to do that. There's a lot there that I'd love to go deeper into, but wow. I do want to do one last pairing though. So Graham, I want you to just take a moment. I want you to channel your inner doomer. The world is going to end. Everything sucks for just a second here.
Yeah.
And talk to me about things like, that the tariff war is going to end very poorly for us, or you can talk about the Gini coefficient, which is kind of like the measures of inequality in the world. I read just recently that there's a record number of Americans in the last year that took European vacations, and there's also a record number of Americans that are visiting food banks. There's people taking loans for DoorDash right now, et cetera. So you're going to be the doomer for a moment or two, and then Matt, I'm going to switch you over and say, yes, there's things that are bad, but actually there's a way we can get ready for this and kind of prepare, and we can posture and kind of get ready for the storm. So Graham, go ahead, and then I'll turn over to Matt.
Yeah, that's a little difficult. I've actually switched from being so doom and gloom all the time because I've I made my bones in 08 because I predicted the crash months in advance and had my clients positioned for it. I was one of only a few people that did that. And so I got this reputation for being really like the world's ending, just because at the time, Wall Street CEOs were saying, "Oh, well, our balance sheets are rock solid." I'm like, "No, there's going to be a full scale crisis." But I've really sort of shifted now to seeing just things from more cost benefit perspective. What I can say is that the system is inherently biased towards assets. Janet Yellen, the former Fed chair, openly said, if you want to get ahead in our financial system, you need to acquire assets to do so. And what she meant by assets was real estate, stocks. If your idea of getting well off is just based on incomes, it's highly likely that unless you have some massive trajectory, like you're a surgeon or you're a corporate lawyer or something, it's, you're likely not going to really be able to retire off your income alone. unless you somehow manage to buck the trend that every American has of overspending and you're just very frugal. Because that's another thing, is how much of the stuff we buy do we even need? And Trump's even saying that with the tariffs. He's saying, your daughter's going to have 2 dolls and they'll cost more as opposed to 30 dolls and they're all really cheap. So what I can say is the system's inherently biased towards assets, and based on that, the people who have assets will have there's going to be a ever widening wealth gap between those who have assets and can leverage up and those who can't. If you look at all the wealth accrued in the last 40, 50 years, a lot of it's historically been entrepreneurs, the Jeff Bezoses of the world and so on. But, these hedge fund managers and these other guys who've become billionaires, all they're really doing is you're leveraging up. You're using cheap, easy credit to borrow as much money as possible and then invest it in assets that are going up in value because the Fed's deflating, the Fed's devaluing the dollar and inflating asset prices, and you're exponentially wealthier. You're worth 100 million. You can borrow 10, 20 million, buy a ton of real estate. Your wealth exponentially increases as the real estate bubble increases in size. If you're someone who's living paycheck to paycheck, income to income, and you don't own stocks, it's very hard for you to sort of, quote, break even against the decline in the purchasing power of dollars. So in terms of the doomer, I mean, the only way I would think about it is just you'd have to start really looking at your own balance sheet of what am I spending money on that I actually really need? And then where am I putting capital to work in a way that's actually going to benefit me down the road? And that's going to really enter into a psychological, philosophical discussion of delayed gratification and like self-sustenance and sort of, prep, which is, I know your wheelhouse, which a lot of people I don't think in those terms anymore. It's very much just, I want what I want right now. I don't care. I'll use credit to get it. And I kind of am rambling here. I apologize, but it's such a complicated mess and we have such little control over it. I think the big lessons from COVID was really, you have to absolutely focus on what you can and cannot control in your life. And specifically from a financial perspective, control your spending relative to where you're allocating capital to try to give yourself a better future, and where you invest, whether it's in yourself or in the markets or whatever it is you're trying to accomplish. But yeah, it's certainly an ugly time because everything's denominated in dollars. And as Matt put it, the Trump administration is very, very open. We want the dollar to lose its value.
Okay. So Matt, what's your response to that? Should my children, hop onto Wall Street bets and YOLO, or what are you looking at there?
Well, let's see. Let me think of doomer stuff first. What are the bad things that can happen here? I think it's important to consider some of the potentially some of the negative outcomes that will come of this. I mean, the U.S. has advocated, the guy who managed trade in the last Trump administration was a guy named Lighthizer. And he advocates for a strategic decoupling from China. And a lot of this is driven by stuff that's national security issues. And so a lot of the trade policies, although while they are pro-American in terms of wanting to bring back manufacturing and that kind of thing, it is, I think, in great part being led by the national security complex, which realizes, holy shit, we can't produce our own armaments. We can't, we need China for everything now. I mean, we have such a globally integrated supply chain, as Graham has articulated very well earlier, that they realized how bad of a position they're in. And so a lot of the harshness, especially with China, is based upon national security concerns, which, again, just like the need to devalue the dollar, does not take into account the negative effects it will have on Americans. My hope is that we are able to do a strategic decoupling, that it can be done intelligently and not be forced into a hard decoupling. But I really think that might not be our choice entirely. China has a say in the matter too. And the Chinese response to everything we've done so far has mostly been to ignore us, ignore the bluster, and just continue doing their work. And part of that work is setting up an alternative global trade system where they are effectively using gold, where, basically where the yuan, you can immediately exchange it on the Shanghai Gold Exchange for gold. If you agree to buy products from them in yuan instead, or trade in yuan instead of having to bridge over to dollars first, which is what everyone has done traditionally, then you can exchange immediately for gold. And they're expanding that by creating different warehouses around the world to facilitate this trade more directly. Now that, if there's a hard decoupling, it really puts the U.S. in a really bad position, because we might want to bring back manufacturing, but the capital goods that we need in order to build that manufacturing, the supply chains for these raw materials, the refining of these raw materials, all goes through China. If we are cut off from that because we end up in a hard decoupling of some kind, the standard of living of Americans is going to go down dramatically. It really will. And so that's really dangerous. Strategic decoupling, yeah, makes sense. Let's buy less from them. Let's make it more expensive to buy finished goods from them. Let's still have access to all the underlying, capital goods that we need to build up our own factories and do that. I mean, that can make more sense. That's a longer view. The problem is that Trump's got a few years maximum to do this. And so because national security concerns trump every other concern that of the U.S. government, it's a very delicate situation. I think we're in a very fragile state right now. And so we have the great risks to the dollar, both being devalued internally, also being not demanded to the same regard as it has in the past by foreign nations and in global trade. So then those dollars come back home, the only places where it's still good in the U.S., driving inflation up more. And potentially the world getting bifurcated through a hard, divide between with us or against us, like George W. Bush was with Iraq. I mean, so that scenario would be devastating to American families, I think. And it's quite possible that we would do that. Hopefully it doesn't go to, and it can even, these sorts of things lead to kinetic war often too. I mean, the Japanese, yes, they attacked Pearl Harbor. That brought us into the war. But what we did to Japan before that is we cut them off from certain things. We say, like, you need oil, you cannot get it. And we completely put basically an embargo on them for critical materials they had to have to survive. And they felt like the only way to respond to that was with war. So will we feel that way if China cuts us off from raw materials that we need, from finished goods that the military requires? Maybe, I don't know. But anyway, so things could get very difficult if supply chains continue to degrade or get completely turned off. I mean, COVID, the experience with supply chains being broken that we had during COVID could look like a tiny little warm up to what we could get now. So that's what I'd say is that it's kind of the worst case scenario is your currency is going down and the lack of access to goods and no real ability to restore the economy internally in any reasonable time frame, causing a lot of difficulty for everybody in the U.S. So those are two really bad scenarios. And I think, you could learn from some of the COVID stuff as we did get a dry run with this. Like, what were some things that made sense during COVID? I mean, think about the way you're spending, like as Graham talked about. I mean, you got to, like, what do you really need in your life? What don't you need in your life? Also, while goods are still cheap and abundant, I mean, one of the smartest investments you could ever do because inflation, it does exist, even if it doesn't show up in the CPI. I mean, if you're going to use, a certain amount of dish soap over the next 5 years, and you have a lot of basement space, I mean, it doesn't hurt to buy all that dish soap now and have it delivered on Amazon versus, I mean, honestly, if you look at that, there was a guy who wrote a book in the 70s called The Alpha Strategy, and it was all about that. He compared that with any other type of investment because inflation was so real. You just buy the stuff you're going to need, you're going to spend anyway, but we buy it now, and that actually allows for a lot of savings. So that's something people should consider. If there are things you need that we definitely get from overseas, you might want to get them in advance. Other things, obviously, I really believe sincerely everybody needs to own some gold. And you don't want to own gold through an ETF like GLD. You want to own physical gold. If you can store it somewhere, in your and you're, buy fence post number 49 or whatever and bury it in your yard. Or, there are some vaulting companies that you can do it with, and that as long as it's segregated, it's like definitely, it's yours in your spot and it's yours. I think that there's some good places to do that. But I think if you've got some savings, at least some of it ought to be in gold to protect you from the downside that's coming.
Okay, so if I was to summarize what you said, the answer would be look at history and kind of what's looked at history long term. Gold is which one of those things, and I'll make sure to go visit your fence post 49 in case I need an extra. So there's one. Number two is just to kind of stock up on the things that you normally and habitually use. So if you're in America, kind of go find your local Costco and stock up, and they sell gold as well. And then the third thing is this crazy thing. There was an SNL skit on this. I think it was with Steve Martin. It was live within your means. So go out and make sure that if your income is X, that your spending is it does not an increase of X. So that's kind of writ large your philosophy for folks. So we're going to switch into the very last topic very quick. It's going to be a lightning round. I'll have both of you kind of go. Give me your gut reaction. I'll ask you a question. Just give me a very quick response to this, and then we'll wrap up and call it a day. So first question is this: 1 year from now, do you think overall Americans will be better or worse? Graham?
I have no idea.
Fair answer.
I apologize. I my personal gut feeling is we're going to have another crisis in 2026 at some point. I don't know exactly when or how, but like we've seen enough kind of ripples in the financial system to sense that something is coming, and there's going to be some sort of wealth destruction again. It could even just be wealth destruction. The fact that like we have another inflationary round, and maybe asset prices look like they're going up in value, but like actually we're all getting poorer very rapidly. But I think we're going to have another crisis in a year that will really make really shape the next sort of half decade, depending on how the policy responds.
I think Americans will feel worse off in a year from now, no matter what, because I do think you're going to see unemployment go up. Layoffs are definitely on the rise, and certainly a public sector, that's the case because Doge doing some of that. But in the private sector, most of them are still in the private sector. The layoffs that are happening. I mean, one of the companies I own in the U.S., we had a job listing for we had hundreds of applicants for this job, and in the last 7 years at this company, that was never the case. So there's people, and this is a skilled job. So I think that what the numbers say in unemployment are not really accurate, and I think that the pressure that people feel on the jobs front, I think that's going to grow. That pressure is going to grow, and so I think the average American, is going to feel worse off in a year. Financial markets, that's a different story.
Okay. Well, since you brought up Doge, that's my second question for Doge. Will these cuts that Doge is identifying and trying to implement, will they be locked in by Congress? Will we actually achieve cost savings through Doge and have a smaller budget than we do this year?
No chance.
No chance? Okay. Graham?
No way.
Okay. You think it's all going to go into the DOD? They just announced a $1 trillion DOD budget as part of their overall big, beautiful bill. Okay. All right, Graham.
Or interest rates, or interest on the debt, or then growing entitlements, which a tidal wave, it can't be stopped. There's no resolution to this budget problem, and Congress is gutless.
Okay, we're going to end rather doomery here. Okay, what about the 10-year Treasury yield? Will it be higher or lower a year from now, Graham?
Can't answer that. It all depends on what's happening in the markets. If things are stable, I wouldn't be surprised to see it. I think the Fed's going to have to start cutting rates pretty aggressively in the near future to try and cushion things. So probably lower, honestly.
Okay. Matt?
Yeah, I think if they do that, I think if it's lower, there'll be lots of yield curve control mechanisms to try and make sure it stays there. Because I think if the market were functioning normally and naturally, I think that rates would have to go up. But I don't think that they can allow them to go up.
Okay, so
that's a great point, because it's hard to answer these questions because we're in everything's managed now. We're not in anything resembling a free market. And so you're essentially, when you're asking questions like this, you're asking me, will there be a situation that's grave enough that we get a intense policy response from policymakers? And then will that policy response have certain unintended consequences sooner rather than later? You look at COVID, we shut down the economy, then we just papered over everything with trillions of dollars, and then we created inflation and we had supply chain disruptions. I mean, trying to forecast that playing out the way it did, I think Matt put it very well. That might have been a dry run for some stuff that's coming, and going to be very hard to tell how it plays out this time.
Okay, so basically, both of your magic 8 balls say the same thing. You've got two answers. One is it looks gloomy, and the other one is try back later. Is kind of what I'm getting from the both of you. All right.
Kind of, yeah. I would be inclined to agree with Matt. I don't think things are on the up and up at all.
Okay. Well, we're going to conclude here with this final pitches. So, Matt, I'll start with you as far as you've had this book that you're working on, I believe, with your son called The Preparation, or at least a project. Can you kind of just explain that and also your Doug Casey's take and then crisis investing?
Sure. Yeah. If Doug Casey is a legendary speculator, he's really a philosopher, old friend of mine, my hero. I do a podcast with him called Doug Casey's Take. It's on YouTube and Spotify, everywhere you can listen to it. The goal of that podcast is for me to try and get Doug to talk, because he's got a lot to teach. So that's the purpose of that. We also have a Substack and a newsletter. It's at crisisinvesting.com. And there's a free version of it where I published this article comparing the income in 1910 to the income today. For example, that was one of the free articles. We also have a paid newsletter where we focus on mostly resource stocks, because that's really Doug's long-term specialty, what he's really known for. Now, this other thing, this book that I've been working on, it's three people involved. It's Doug Casey, myself, and my son, and it's called The Preparation. It's something Doug has tried to get me to write for more than a decade with him, and I never had any interest. And essentially, the theme of the book is what a young man should do instead of, as Doug would say, misallocating 4 years of his time and capital to college. Now, he went to Georgetown. He was always, so he's had a good education, but he's always believed, even that then, when it was cheap, long ago, he thought that was a misallocation of his time and money. And I think that's even more so true today, generally, of college than it was when he went to college. It's very expensive. And the biggest thing is the time it takes. 4 years, 4 key peak years, between 18 and 22, when, you have unlimited energy to be forced to 12 credit hours is considered a full-time student. It's crazy, actually. It's not even a part-time job. But so what this does is it says what you should do specifically instead. And we lay it out in 16 quarters. We call each quarter a cycle, and each cycle has an anchor activity where you learn a hard skill, doing something. Like my son has been the beta tester for this for the last 2 years. So what finally encouraged me to do this book with Doug was the fact that my son at 17 was unclear what he was going to do. Okay. Also, this was definitely still had some COVID hangover, so it made everyone reconsider, at least for me, what I was doing with my life and where I wanted it to go. And it kind of reframed decisions, I think, for a lot of people. But for him, he didn't really want to go to college. But the question is, what do you do instead? You don't want to end up in a dead-end job. You didn't want to join the military. I mean, what are your choices? There isn't a conceivable alternative that's articulated anymore. I mean, I guess you go to a community college and, get a welding certificate or something like that. I mean, those are the only other options. And for the most ambitious, intelligent people, by default, it's college and only college. That's the only option. And what we do is attempt to outline something else, something totally different than that. That the idea is that when you leave that 4 years, you're competent in a number of things, a number of real skills. One of the things he did in one of the cycles was he became an EMT. Now, an EMT, is that really that valuable? Well, it is. If somebody needs some immediate care for some reason, it's really helpful, but those jobs don't pay well. So it's not like that's a great career, but that's a good skill. And it's led to other interesting things for him, including he did his last summer, he spent the summer doing wildland firefighting, making $600 a day as an EMT. That's a pretty good summer job. I mean, when I was 18, I think my take home pay from the Army was like $600 a month, something like that. So much better in that regard. Another cycle he went sailing, starting in the Falkland Islands and through the Strait of Magellan with one of the best high latitude captains on Earth. So he learned that as his anchor skill. And it bundled within all these anchor skills is all the same academic stuff you would get if you're going to college, but it's available online. You know, I mean, all these courses, the best courses are all there. They're available. And so you get the academic and you get the experiential and all these anchor activities. You learn a real hard skill where it has economic value in the world. Like he's qualified, he's a qualified crewman on a sailboat now. He could go and do that if he wanted to. I mean, he could be an EMT if he wants to. He's done, obviously we run a regenerative ranch, so he's done everything here from shoeing horses to everything imaginable with the cattle. Usually not worth going into, but explaining how that works. So the idea of the preparation is by the end of the 4 years, the young person truly is prepared to live as an independent adult, creating value in the world. They're competent, confident, and dangerous too. And dangerous in the way, of course, part of the program, obviously martial arts is part of it, being able to defend yourself, that's a big part. But mostly it's being an independent thinker, being able to, the things that made Graham recognize that we were going into the GFC before it happened, is because he's an independent thinker. There's a shortage of independent thinkers in the world, and independent thinkers are extremely dangerous. Hence, the preparation is designed to help them become that. So we're almost done with the book. Doug's finishing up his last little part. Hopefully, we'll have it published soon. I mean, very soon. Hopefully.
Well, you sound like a very proud father, and that's a very intriguing endeavor. I'm very interested. I think I'm going to definitely read the book on that. And then for Graham, you've got to.
I got to say one last thing about it, okay? As you say, proud dad, I got to tell you. 2 years my son's been doing this. He was a boy. He's a man now in 2 years. I don't know when exactly it happened, but sometime along that, he's not a boy anymore. And it's just so obvious to me. It's crazy, actually. It's shocking. It's just like one day I woke up and I was like, holy shit, he's actually a man, independent. And he's doing very well. So yes, I am quite proud of him. And if this could work for other people, which I think it can, then I think we'll have done something very good.
Thanks for sharing, Matt. I appreciate it. Graham, you've got a ton of different investments, so and a newsletter. So go ahead and pitch what you want to talk about.
My focus is just on helping people try to allocate capital in a way that they're going to grow their portfolios and be able to retire safely. And we have different portfolios modeled on different things. You know, if you're an independent individual investor who's trying to do stock picking for long-term capital appreciation, we have a newsletter called Long-Term Alpha. If you're more active and you want to be really tracking this stuff we're talking about on a weekly basis and sort of playing all the little nuances of the policies and things, we've got Private Wealth Advisory. That's stock and ETF trading. I've got some options trading services for the more aggressive people. And we've got a crypto service too, because at this point, that's sort of the Wild West for capitalism. My whole thing is primarily sort of preparing yourself financially. I don't really get too much into individual recommendations for what someone should do with their life. I did more of that in the past, but it's more just simply that owning assets. What assets do you want to own? Because unfortunately, that's the way the system's set up. And so how do you want to allocate the capital you do have in ways that your capital is appreciating in a way through asset price appreciation? And as a result, you're financially secure in the future.
Thank you very much, Graham. I will conclude here. My name is Dr. Chris Ellis. This is my first time hosting Doomer Optimism, so I had two phenomenal guests. Thank you so much. I am writing a book right now. It'll be out. It'll be published on the 4th of November. It is called Resilient Citizens, the People, Perils, and Politics of Modern Preparedness. I look at roughly a 70-year history of the prepper movement back from the 50s and on to today, and how it has gone from, it was mainstream because it was what we used to do for thousands of years of our human existence. It was changed quite a bit because of World War II and the nuclear shadow, and went into what, for about 50 years to be considered kind of crazy town. And now it's making a resurgence to being more of a return to the way we did things. I look at various different ways that people look at preparedness, from homesteading to owning guns to owning gold, etc. It should come out for pre-order here in a few months, but I wanted to say thank you everyone for your time, and thank you for joining Doomer Optimism. Thanks so much. Have a great day.